Thank you all again for attending. Anthony, thank you so much for this exciting sales idea. And I will tell you real quick while we're getting this set up. As I mentioned, this is a series webinar. So we have two other webinars after this. And not to steal Anthony's thunder here, but the way this is going to work, that he's going to wet your whistle and explain how this works today. But if you want to attend the second and the third, you would need to be appointed with us in order to attend those. So this will be, this is kind of get you interested, and then we'll get you out the contracting documents. And once you get your contract in, you'll be invited to the next two webinars that follow this. So Anthony, I'll go ahead and turn it over to you. Thank you.
Thanks, Mark. I appreciate it. And good morning, everyone. I appreciate you taking the time from your busy schedule to join me on this call. Some of you may be familiar with the privatized banking concept. You might know it more as becoming your own banker, you be the bank. And this is something, well, let me just give you a little background on me. I'm 14 years in the business. I discovered this concept a little over 4 years ago, actually. And I learned of it actually from one of the partners with my company, and found out about it. Actually read a book from Nelson Nash. You may have heard of who he is, and that's something that I'll speak to Nelson quite a bit because he's sort of the godfather of this concept. He wrote a book called Becoming Your Own Banker that it really has changed my life. And so what I did was I wanted to know more about this concept, so I found out who the #1 private banking practitioner was, and I went and studied underneath him for about 18 months. So I learned everything I could from him, and then I pretty much transitioned my practice. I was independent. I went independent in 2007, and so in 2011, I've really transitioned almost exclusively now into this concept. And so I'm excited to share it with you. And what it is a private financing system. What we're going to talk about is actually what it is, how it works, and why you should be sharing this with your clients. And I know a lot of you guys on the call may be veterans, and you've done life insurance in the past, or you do life insurance now. And I know life insurance can initially be a little more frustrating than annuities. I mean, you typically can get paid a little quicker with an annuity. You don't have to mess with the underwriting concept. But this process really does ease not only underwriting, but it takes the selling of life insurance out of the picture, because we present it in a way that's completely different. We're not selling a death benefit per se. We're selling a private financing system that once your clients learn and understand how the concept works, it's almost a no-brainer. I will say that this is a system that is not, it will work for everyone. Any one of your existing clients, it will work for you that is on the call right now. It will work for any of your family members, but it's definitely not right for everyone. It does take a form of discipline, desire, and determination to really understand and to stick with the system. It's like anything worth doing well, it takes those characteristics, and this is no different. But I, as a wealth coach, walk my clients through the process, through the implementation process, as well as coach them through exactly step-by-step of what they need to do. And then eventually, they take the steering wheel, and it is life-changing. So I'm happy to share it with you guys. What is it? The private financing system, or sometimes we refer to it as privatized family banking. This is a system that is uniquely designed. It is a uniquely designed process that utilizes a properly structured dividend-paying whole life insurance policy to finance anything on which one spends money. Now, I'll read that again. The private finance system is a uniquely designed process. And I say that because this is not a cookie-cutter concept. This isn't something that you can just, set up for anyone the exact same way, because it's not going to be the same for the next person in line. Uniquely designed mainly because there are really two types of people that you'll introduce this to. On one end, people who might be heavily in debt. And so we create a debt recovery analysis for those clients. And then you've got the clients who probably most of you are attracted to, which is, you're typically 60 and older. Maybe they don't have a lot of debt, but they've got the assets that are sitting out there. And so for those people, we do more of a cash flow analysis. And that shows them, how to use this system going forward. Because one thing I've found out is everyone spends money. And so this concept, like I said, it will work for anyone because we all spend money. And if we can create a process that allows us to actually recapture anything we spend money on, then it's a win-win for everybody. This is a process that utilizes a properly structured dividend-paying whole life insurance policy. Properly structured, most life insurance agents, I was one for 10 years, and I never sold a policy this way. I was never trained. I was never taught. A lot of people think whole life insurance is sort of your grandfather's insurance, and it's outdated. And there's other products out there, other life insurance products such as the universal lives that are a little more attractive. But I will say that a properly structured dividend-paying whole life insurance policy is probably one of the most powerful financial tools I've ever come across. And that's why we use only whole life insurance with this concept. And I'll explain a little bit further why we don't use universal life for the banking purpose. I'm not opposed to the ULs and the IULs. I think they're an amazing accumulation tool, but for banking purposes, the whole life insurance policy is definitely the way you want to go, and I'll explain why in this presentation. So what I want to share with you guys, and please, and Mark, I know you're going to kind of take the reins on this one. If you guys have questions, type them in there, and Mark can stop me, and I can address those questions as we go. Because this concept it's a paradigm shift. It is a completely different way on how we think about how money works. And so it's not what we're used to. We don't focus on a rate of return for our clients. We focus on volume of return. And most people don't understand, the difference between the two. So what I'm going to do here is just kind of go through my presentation on how I would go through it with my clients, and obviously address you guys a little bit differently because you have a little bit better understanding of what we do. But so let's dive into why this concept is valid. So how much are we really keeping? Let's look at the average Joe today, the average American today. Let's just say he's earning $100,000 a year. The average American today is saving 5% of their income. That means that $95,000 in this guy's case, from January to December, comes into his world and then goes right back out. Taxes, bills, expenses, interest, debt, it all adds up. And that's pretty much the way most people live. They earn an income from throughout the year. They save what they can, but the rest goes to expenditures. I mean, from housing, auto, living expenses, taxes, we only retain a small fraction. So if this guy is saving 5%, or in his case, $5,000, let's say he can earn 10% on his money. So he sticks that $5,000 in, whether it's his 401k or whether he gives it to one of us, and we are able to turn that into a 10% rate of return. That would mean that he has a $500 gain on that $5,000. What we do is we try to turn the average Joe into prosperous Joe. And just by teaching him this concept, we start small. And what if he could find a way to recapture 1% of that $95,000? And I'll explain a little further what recapturing means on the next slide here. But if he was able to bring back just 1% of that $95,000 that comes in and goes right back out, that would be a $950 gain to him. And if you compare that $950 to the $5,000 that he's saving It took him 10% to get the $500 gain. Just recapturing 1%, we were able to basically give him a 19.5% return compared to that $5,000. And that's just recapturing 1%. Our clients on average are recapturing anywhere from about 3 to 7% in year one. Imagine if they could recapture 10, 20, or 30% of their income that's leaving their pool. The average American today is spending 34.5% of this $95,000 in interest alone. And that may sound mind-boggling, but if you look at an amortization table on a mortgage, what are we paying the first 7 years of a mortgage? We're practically paying 80 to 90% in interest alone. When you add auto payments, credit cards, student loans, it adds up. So who controls the money? This is a concept basically called becoming your own banker. So if we understand how banks work and what a bank does, we play typically two roles. We play the saver and we play the borrower. And then there's the bank. If we understand how banking works, when we put $1 into the bank doesn't just let that dollar sit there. They loan it out to somebody else and charge an interest rate, all the while paying us a much lower interest rate just for the convenience of housing our money for us. The transaction does not end there. Once the bank loans out our money to someone, that person puts that money to use. And let's say they buy a car. Well, when that person takes our money and hands that money to the dealership hands that person a set of keys. When that dealership closes its door at night, where is the very first place they take that cashier's check? They take it right back to the bank. And that's how banks recapture money. They recapture our money, and they make a wonderful profit in doing so. So let's kind of go through that here. Again, we, as the saver, put money into the bank loans that money out to the borrower puts it right back into the bank through payments, and then the bank pays us interest on our money. So let's say we put $10,000 into the bank. And let's give them the benefit of the doubt and say they're going to pay us 3%. I know we're not earning 3% on a bank right now, but the historical average of a CD over the last 35 years is about 4%. So let's just say the bank is paying us 3% in this example, or $300. So the bank is going to take our $10,000 and they're going to loan it out to somebody, charge them 6% for a car. Well, we already talked about that. The dealership is going to put the money right back in the bank. So the bank's going to loan that same money out again to someone for maybe some debt consolidation, and they're going to charge 7%. Again, they're going to receive that money back, and let's say they do it one more time and they loan it out to someone to do a home remodel. Well, once that handyman gets paid, the very first place he's going to put the money is right back in the bank. So in this example, the bank loaned out our money 3 different times and earns 21% in doing so. Now they had to pay us 3%. So you could look at it from a percentage perspective that the bank made 18% more than we did. 21% minus the 3% would be 18%, which is not really the case, because if they made 18% more than we did, they would have only made about $354. The bank, if you can understand how the volume of interest, they made actually $1,800 or a 600% profit. And you get that 600% by taking the 18 divided by 3. And they made 6 times more, or 600% profit than what we made. We made 300, they made 1,800. And banks do this all day long. And I'm not even talking about fractional reserve lending. If you understand what that is, and I'm not going to get into that today, but the bank's ability to lend money that does not exist, which we could say is the issue behind inflation. So banks understand how money works, And what we can do is we can basically create our own banking system to where we can eliminate the bank making this profit, and we can put this profit right into our own pockets or our clients' pockets. I love this slide because this really does put a perspective on how little we understand how money works. Cash or finance. Most people, when I ask them, if you had the ability to pay cash for your next vehicle, would you pay cash or would you finance? And 99% of the time they say, oh yeah, I'd pay cash. That's what we're taught. I mean, if you look at some of the financial gurus out there today, you know, one of them in particular, his slogan is cash is king. You should never finance anything. If you don't have the money, you don't buy it. But let's look at that scenario and say that someone's going to basically pay cash for a car. And let's say they had $30,000 saved up, and they had it in a CD, and that CD matured, and it was time for them to buy a car. And they were going to do it what they felt was the smart way, and they were going to pay cash for this vehicle. So they went to the bank, and they talked to the bank president. Let's say it was me, and they said, Anthony, it's a great day. We're going to buy our car. We'd like to liquidate this $30,000 CD. And I say, you know, there's another option. You could actually leave that CD and renew it, and we'll pay you 4% interest. Again, I'm giving the bank the benefit of the doubt. I know we're not earning 4%, but this is historically the average interest rate on CDs. I think we can attribute the 80s for that with high interest rates. However, in this particular example, the bank is going to pay 4%. So I'm telling the customer to leave their money and renew the CD, and we'll pay them 4% interest for 4 years, about the length of a good car loan. And by doing this, we'll use the $30,000 CD as collateral, and we'll actually give them a $30,000 loan. And since we're paying them 4%, we're going to charge them 6% for 4 years. Now, to most people, this does not sound like a good idea. Why on earth would I leave my money alone with you guys, with the bank, earning 4%, and then take out a loan and have you charge me 6%? I'm not going to do it. I'm going to pay cash. And that's how most people think. But if we do the math, $30,000 sitting inside a CD over 4 years at 4%, it's going to grow to $35,196. And it will earn $5,196 of interest. A $30,000 loan at 6% for 4 years, obviously that person's going to make payments. And over the course of 4 years, they're going to actually pay $33,818. They're going to pay $3,818 in interest. That is $1,378 less than what they earned by leaving their money alone. This is called opportunity cost. And this is a big factor when it comes to becoming your own banker. If you read Nelson Nash's books, he says you finance everything you buy. I'll say that again. You finance everything you buy. You either borrow the money from someone else and pay them an interest rate for the use of their money, which is traditional financing, or you pay cash. And by paying cash, what you do is you give up the opportunity to earn any interest on that money forever. So if this particular person would have paid $30,000 in cash for that car, they would have lost the opportunity to earn that $5,196. Now, going back to this example, you might say, but how is that possible? How can you earn 4% and be charged 6% and actually come out ahead on the 4% side? Well, it's compounding interest. Sorry, I went backwards there. Albert Einstein said, compounding is the eighth wonder of the world. Those who understand it earn it, and those who don't pay it. Well, compounding interest on the left side here, you're earning 4%. You're not just earning 4% on $30,000 after the first year. You're earning 4% on $31,200. And likewise, on the loan, you're not paying 6% on $30,000 after year one. You're actually paying 6% on $22,577. And that's how compounding works. But to the the average person, it's better to pay cash. But if we understand how money really works, you can even change this 6% interest that the bank loans, you can change that to 8% and still have the bank pay you 4% and you'll break even. Isn't that amazing? I did not know that. And this is one of the slides that when I was first shown this, it really made me go and research this concept, because we are leaving so much money on the table every time we buy things with cash. So what we do is we offer our clients a third choice. We say, you know what, if you're going to pay cash for something, you had to save that money up in a bank. Why not save it up in your own bank? Why not put $30,000 into your own system? And when you want to buy a car, you borrow that money out. And you actually charge yourself interest because you're going to pay it back. You're going to treat it like a bank. Now you might say, why on earth would I charge myself interest for the use of my own money? Well, it's a concept called economic value added, or EVA for short. There's a book out there. It's extremely thick book, and it'll put you right to sleep. But it's a pretty amazing concept, because what it basically is saying is that your capital has value. And if you were to loan your money out to anyone, or if you were to borrow money from anyone, through that transaction, interest would be exchanged. Why, when we use our own money, are we not charging ourselves interest? If we're not, we're basically saying that our capital has no real value. So whenever I take a loan from my policies, I charge a minimum to myself of 10%, because I think my money is worth at least 10%. But if you just mirror what the bank was doing and charging 6%, then that means you put back into your system the $33,818 as well as the $51.96. Because if you understand how whole life insurance works, participating or dividend paying whole life insurance, when you borrow money from your cash value life insurance policy, your money actually stays put. You're borrowing the insurance company's money, and they are hedging and leveraging your death benefit as collateral, because they know one thing: one day we're going to die. And so whether we pay the money back into the policy and pay the loan back, or whether we pass away, the insurance company is going to get their money back. And so what that means is that our $30,000 actually stays put inside the account, and it continues to earn dividends and interest as if we never touched it. So not only do we pay ourselves back that 6%, which is that $38.18, but in this particular example, if our money earned 4%, that $30,000 would have also earned the $51.96. And at the end of 4 years, there would be $39,014 sitting in that bucket. And guess what? That bucket is liquid, tax-free, and usable. You can borrow it out again to do, maybe buy another car, or take a vacation, or pay for your, daughter's wedding, anything and everything. But what we've done is we've recaptured and basically gotten back all of the principal and interest that we paid for that vehicle, and made an interest rate as we were, going throughout that 4 years. Okay, building your own bank, how does it work? Well, if you have a general understanding of how life insurance works, and this is one of the things we're going to go over in more detail in another webinar, to really break down how the policies work, because you've all run life insurance illustrations in the past, and this mirrors that to a degree. So I say building your own bank is like starting your own business. And it's been said that banking is the most important business in the world. And if that were true, then everyone should be in two businesses: the business we're in and the business of banking. Same for your clients. Whatever business they're in, even if they're retired, they should have their own bank. And let's say we're going to start a bank. Well, the average bank, it takes 7 years before they're profitable. There's a lot that goes into starting up a bank, and they are not. The average bank is profitable in their 7th year. So let's look and see what it looks like to build our own bank. And I'm going to use small numbers because it's easy to do the math. And let's just say we put $1 into our bank in year one. Well, right away, we have 57 cents of that dollar available. We can do whatever we want with it. And the business is still running. Our bank is still up. It's still running. The bills are paid. The lights are on. And we have access to that 57 cents. We had a pretty good first year. In year two, we put another dollar in, or actually just 12 months later, we put $1 in. Of that dollar, we have 60 cents available. So we had a better second year. In year three, we put $1 in, and we can pull about 90 cents of that dollar right back out. So third year is looking better. And it's that fourth year, sometime sooner, when we put $1 in, that we can actually pull that dollar right back out. So the cost of doing business from this point forward really is zero. What we've done is we've just created a savings account, but a savings account that I call on steroids, because in year five, when you put that dollar in, you can actually pull, of that dollar, you can pull $1.10 out. Because I'm in year number 4 right now. I've been doing this for 4 years. So finally, every dollar I'm putting in this year to my first policy, it's that same dollar is available to borrow right back out. I'm really excited about the following years because next year when I put that dollar in, it's going to make more. In my 10th year of my policy, when I put $1 in, that dollar, every dollar I run through my insurance policy is going to make me $1.70. I always say to my clients, what if there was a bank out there that started advertising and they said, hey, come bank with us. And you know what? If you continue banking with us for 10 years, every dollar you run through our savings accounts or checking account or any of our accounts, every dollar you put through, we're going to give you $1.50 or $1.70, somewhere around there. Would you bank with them? I would. I would bank with them and put as much money as possible into their system, into their bank, which is what we're doing here. We encourage our clients to put as much money as possible into the banking system, because if they understand how it works, they know that eventually every dollar that they earn realistically should be going through their own bank. Because if the average Joe was running $100,000 through his own bank, in year 10 he was making $170,000. That was liquid and usable and tax-free. So let's take it one step further and actually show you how to recapture debt. Now, this was me. This example is not me, but 5 years ago, I was a pretty successful financial advisor. I was doing pretty well. NDRT made the trips to when I was with Pi, which is part of Vines. But I had a lot of debt. I was the average Joe. I was saving very little, and I had car payments, the mortgage, a little bit of credit card debt. This concept really showed me, and 4 years later, how much debt I've recaptured is really astounding, and I haven't had to work any harder or change my cash flow. And this is how it works. So in year one, when we put $1 in and we've got that 57 cents available, let's just say we owed Visa 57 cents and we were paying them $0.05 a month. What we would do is we would buy that debt. And that's what you're doing. When you become your own banker, so if you understand how banking works, debt is not bad when you own it. If it was, then banks would not constantly be trying to loan money out and credit card companies would not exist. Because when we put money into a bank, to us that's an asset. To a bank it's a liability until they loan that money out. Then it becomes an asset. So we really want as much debt as possible if we control the debt. Because what would happen is if we had 57 cents that was available, liquid, usable, we'd go and buy that debt from Visa. And if we buy that debt from Visa, now we are in charge of that $0.05 a month, and it comes back to us rather than to Visa. And let's say we paid that for 10 months, and we put 50 cents back into our possession. So year two, we put $1 in. We've got that 60 cents available. We've also got that 50 cents to work with that we would not have had before because it was going straight to Visa. We have $1.10. And let's just say we had a car payment that we owed $1.10 on, and we were paying 10 cents a month. Again, we'd take that $1.10 and we would buy that debt from whoever owned it. And now we would own that debt. And that 10 cents a month for a year would no longer go to GMC or whoever you have that car payment through. It would go to us. And we'd put $1.20 back into our possession. So in year 3, when we put that dollar in and we've got the 90 cents available, we've also got that $1.20 to work with that otherwise we would not have had. And let's say we had some inventory because we just started a business and we owed $2.10 on it and we were paying 18 cents a month. Well, guess what? We've got $2.10 sitting right over here. We're going to buy that inventory debt and we're going to put 18 cents a month back into our system, which for a year, that's $2.16. So in that final year of year 4, final year of this example, when we put $1 in and we've got $1 available, we've also got that $2.16. So we've got $3.16 to work with. In the first 4 years, how much money did we put into this? We put $4, right? If you add up the 57 cents, the $1.10, the $2.10, and the $3.16, that's $6.93 that we've recaptured. That means that's $2.93 that over this 4-year time frame, we still spent. If we never would have done this, we would have still spent that $2.93, but it would have gone to Visa, the car payment, and whoever had our inventory debt. All we did was just redirect where that money was going. We became the banker, and that $2.93 that otherwise would have left our possession and gone to someone else just came right back to us. And guess what? We were able to use it again. And that's the power behind becoming your own banker.
Anthony?
So how does it? Yes.
We've got a few questions that have kind of stacked up here. Do you want to go through those real quick?
You betcha.
Okay. Let's see here. I'm going to take this one out. I'll address it. If a business owner, okay, let's see. This is a multi-part question, looks like. Okay, what about the cost of the loan interest? You may have kind of already addressed that.
Well, yes and no. There is interest, obviously. When you borrow money out, you do pay, the insurance company charges you interest because that's how they make money. The insurance company is going to make money really one of 3 ways. First and foremost, you as owner of the contract or our clients as owner of the contract, we have the first dibs on that money. Anything that's in the cash value, the equity, is available to us. And if we borrow that out, not withdraw, but actually borrow the money out, the insurance company has to make a profit. And so they're going to charge us an interest rate. If we don't use the money, then they're going to go out and they're going to buy bonds or they're going to buy real estate because they need to make a profit. And so the companies that we use, and I'll address that here, coming right up, is we use companies that have track records where they have paid dividends, which is a return of premium, a return of, basically they're profitable for well over 100 years. I mean, there's companies out there that have paid dividends for 170 years in a row. So what happens is, if you think about it, when you are charged interest for that loan and you pay that interest back and you actually add more interest on top, the insurance company is becoming profitable and then they create a dividend. Well, who gets the dividend? We do, as policy owners. So in a sense, that money comes back to us, and it comes back to us over time substantially more than what we're charged for. And the nice part about it is, historically, the interest rates have been very, very low. Even like in the 1980s, when interest rates were, 16, 18%, most insurance companies, for their cash value, charged less than 8%. And why would they do that? Because they know that they are contractually obligated when they make a profit to return that profit back to the policy owners. So if they charge more interest, all they're doing is just paying us back more. So it's really a win-win. And it gives us the ability, the use of our money. Yes, we are charged interest for that. But 2 things happen. One, and this is something I'll explain more as a coach to anyone who really wants to, explore this concept. One, the dollar gets weaker as time goes by. So you can borrow money today from your policy, and they leverage it from your death benefit. So if you never pay it back, you actually pay it back with weaker dollars, because there is no hiding the fact that our dollar is the strongest it's ever going to be today. So we get to borrow strong dollars today and pay them back with weaker dollars. And so I know I kind of trailed off there, but hopefully that answered the question.
Okay. And then here's another one. Are you counting the interest paid in the dividend twice? You already show dividends once and add the interest we are paying to cash value. I'm going to read that again.
Hold on here. Yeah, say that one more time.
It says, aren't you counting the interest paid in dividend twice? You already show dividends once and add the interest we are paying to cash value.
And add the interest we were paying to cash value. I think you're referring to, and I won't run back there because to when we pay ourselves, charge ourselves the interest, as well as what the interest is accumulating. That is, we're paying ourselves above and beyond. That 6% that we're paying ourselves back is basically above and beyond what the insurance company would charge us, and that's just from an example perspective. It actually gets better than that as time goes by. I mean, like I said, the longer you have this policy in force, this is kind of like a marathon. It it seems like it may not be very strong up front because you're only getting back 57 cents on the dollar, but as time goes by and you surpass and you become 100% efficient, where every dollar you're putting in, you get that dollar back. But no, you're not paying that back twice because you're charging yourself an additional interest rate.
We have another question. If a business owner does this and charges himself 10%, is that interest expense deductible as a business expense?
It is.
Mm-hmm. Should be.
Yes, it is. And how that works is basically with any client you might have that is a business owner, the business will not own the policy. The individual will own the policy, and the individual will then borrow money out of their policy and loan it to the business. So the business actually has a loan against it, which then the interest rate can be determined however you'd like it to be, because you control the banking system, and the business will be able to deduct that interest paid back.
Here's a fairly long one, Anthony. Can a business owner factor his receivables with his life insurance contract? And if the answer is yes, which assume that it is, then as the payments from the business go to the owner's life insurance policy to repay the funding for the factoring, does he have to recognize the amount received above the funding as income?
Yes. Yes, you do. Above and beyond, absolutely. Above and beyond what the interest charged. If I understood that correctly, but the first part, yes. For receivables, you can. I mean, my mentor, he pays his entire staff using the policy, using one of his 87 policies, if you will. And it takes a series of policies because if you understand how the life insurance, whole life insurance works, is once you establish a policy, you cannot add more to it than what you originally created, or else it would become a modified endowment contract. So you have to set up a series of policies. But yeah, to do receivables, you can. And then I think you had said, are you charged interest above and beyond? Can you read that second part?
You know what? Actually, I deleted the question. I'm sorry. Over and above.
I think it was. Yeah, over and above. If you're charging yourself, then yes, that interest above and beyond would be, earned interest income.
And I have a lot of questions here for you. If you pay yourself 10%, where does that amount show up on the policy? Paid up additions or where?
Wherever you want it to. It depends on if you're, and that's again more of a kind of an advanced, but I love these questions. As we structure the policy, what we do is after the 4th year, when we put our dollar in and that dollar becomes 100% efficient, meaning every dollar we put in is making a dollar, we drop off, and I'm kind of getting ahead of myself here on the presentation, but that's fine. Obviously, these are done through paid up additions, through a paid up additions rider, and I think most of you probably understand what that is. We drop off typically after the 4th year the paid up additions rider, and what that does is when then we have a loan and there's extra interest, because if we were paying the full amount, you know, the premium plus the paid up additions rider, and we charged ourselves interest, then we could not take that extra interest and put it back into the original policy, because then it would become a modified endowment contract. So what we do is either we, when we drop off the PUA and the extra interest, we either add it in as PUA, or by then, typically by the 4th year, most of our clients have at least another policy that they can contribute that way, or take if it's a big enough loan, they can take the interest alone that they're earning and buy a policy using the interest alone. This is done through a series of policies. Like, for instance, I've been doing this for 4 years. I have 6 life insurance policies that I've created for this concept, because I've recaptured in the last 4 years about $45,000 of my income that was going out to bills, you know, other third-party debt. And so my first policy obviously was not $45,000. It was nowhere near that. But what happens is now that I'm bringing back more money, my goal is not necessarily to pay back my policy right away. My goal is to buy as many policies as I can, because I want to get to that 4th year on each of my policies. And once I get to the 4th year where it's dollar for dollar in, then I'm going to start paying back my policies, the loan. I really don't care about the loan or the interest being charged, because it's going against my death benefit. And the beauty behind a whole life policy, your death benefit increases every year. It gets bigger. So even though there's a loan against your death benefit, well, your death benefit continues to grow. And I'm going to pay back my loans with weaker dollars. See, if we understood how money really works, inflation alone, I mean, 10 years from now, what costs us $1, 10 years from now, at a 3.5% inflation rate, is going to cost us $1.41. Our money is being devalued on a level that is, we all understand it. I mean, since the inception of the central banking system just over 100 years ago, we've lost 98% of the value of our dollar. And so I don't focus on that loan, paying that back right away. I want to get as much premium in as possible, because I know that in my 10th year, when I put $1 in and my policy is going to make $1.70, I basically created an inflation-proof system. So, again, go ahead.
I was going to say, if you want to go ahead, we can pick up some of these questions towards the end, so you can get through the.
Sure.
If you like, because.
And I'm pretty much I addressed a lot of this. We use back to the slide here. We use mutual companies. We use mutually owned companies because we don't want the board of directors putting the shareholder first above the policy owner, and mutual companies typically have a track record that where they have paid dividends for, like I said, well over 100 years. We also focus on non-direct recognition. Some of you may not know what that means. I did not know what it meant at first. It basically means there's two types. There's direct recognition and non-direct. Non-direct recognition focuses on basically when you borrow the money from your policy, they do not recognize that, in the sense that's the easiest way to understand that. And so they will continue paying you the full dividend as if you've never touched the money. There are companies that are direct recognition that the banking concept can work, but we don't use them. Again, we focus on paid up additions rider. The paid up additions rider is what really thrusts this policy into where you can have the cash value available right away. And again, most of you understand what paid up additions are, but on the future webinars, we kind of get into that, and I show you through an illustration, an actual illustration, how that works and how we utilize the paid up addition rider, and then when we drop it off, what we do with that. UL and IUL, the reason it's kind of frowned upon in the banking, in the private banking world, to use a UL or IUL is because of that cost of insurance factor. When, if you've got someone who's focusing on banking, they may be 88 years old and have substantial loans out there, and then their cost of insurance will continue to increase, and that policy would have the jeopardy of imploding. And if that would happen, then the taxable ramifications would just be horrendous. So the UL or the IUL, it's just on a different, it's based on, that annual renewable term chassis, and that's a dangerous game to play with banking. From an accumulation perspective, they could work great, but we don't use them for the banking concept. And the benefits for you guys, especially if you're an experienced agent, you've got a book of business out there, we always look to go back to our clients and find out, different ways to either add product lines or, to keep that client happy. And it's, as we all know, much more rewarding to be able to go to an existing client and write new business than have to go out and prospect new clients. And so, to get in front of existing clients, I tell you, especially most of you guys probably have, your client base is 60 and older. Well, Nelson Nash in his book, Becoming Your Own Banker, talks about basically leaving a legacy and creating a system that will last forever, even well past your client's life expectancy. But, to set up their kids, their grandkids, and their great-grandkids. And so to be able to go to your, 65, 70-year-old clients who we all know that underwriting would not be fun, but to be able to underwrite their grandkids, underwriting is, minimal at that point. And what you've done is created a line where they will, their kids, your clients' kids will inherit those policies, continue to use them, and then you've created a generational wealth transfer for, 2-3 generations ahead. So that's what we talked about, talk to your kids and grandkids. Not to mention, you get with your clients, and your clients say, this is a great idea, I'd like for, my kids to get involved. Well, this is the easiest way to get in front of 30 and 40-year-olds. Whereas before, we may not have had a real reason to, because no one wants to buy life insurance. With this concept, you're not selling life insurance, you're selling a concept. And so to be able to say, hey, you know what, next time we meet up, Mr. and Mrs. Jones, why don't you have your 2 daughters and your son join us? And you know what, bring their spouses as well, because this involves them. And then you can give this presentation to a bunch of 30 and 40-year-olds who might be somewhat in debt, and they see how this concept could work for them. Now you've got new clients. Commissions are great. The best part about this is if you get a banking client, they're not going to just have one policy. As time goes by, they're going to buy multiple policies. Every one of my clients that I've had for at least 3 years has bought another policy, because you almost have to. If you do this the right way and you do this the way that we teach our clients, they will buy additional policies. Not to mention the renewal. The commissions are fantastic. Every year if that person pays their premium, you get a new renewal commission. And then Wealth Insight, you have me as a resource. I have the heart of a teacher. I love sharing this concept with other agents. I have a couple agents who work with me, and I've taught a couple other agents over the years, how this concept works. I'm pretty good at what I do. I had extensive training, and it's really where my passion is. So, I will educate you to a level where you will be an expert in this concept. And case design is my favorite part of this whole thing. Getting someone's situation. What we always say is we take people, we will improve their financial situation without them working any harder or changing their cash flow. I mean, most, again, financial gurus will say, hey, you know what, you've got to cut your cable bill, you got to live on rice and beans, no more eating out, and you've got to pick up a second job delivering pizzas in order to tackle all this debt. We can pretty much, most people don't understand hidden wealth transfers. We can pretty much take anyone's situation and show them how to just move money around to create a policy that will start tackling their debt, so they don't have to work any harder or change their cash flow. And that is basically it. Again, my name is Anthony Lawrence. My partner is Ken Billinger. He may be on the call now. And again, this is a concept that it's a paradigm shift. It's a different way of thinking. But you know, when we sit down with our clients, or especially new prospects who've never heard of this concept, we can show them. Oftentimes, we don't even mention life insurance because it's not about the life insurance. It's just about the way money works, and it's about the process. So it could be a wonderful arsenal that you could add for your existing and new clients. Mark, are there other questions or?
Yeah, there are actually, and you know, I guess real quick too, as I'd mentioned, I noticed that some of you had joined in after the original introduction here, but this is the first of 3 different webinars. And so what Anthony is going to do in the next webinar, he's actually going to use an existing client. And so what he'll do is he'll go through the process. And so if you want to attend the next 2 and the second one and the third one, you'd need to be appointed with us in order to do that. And so we will email you the contracting for Security Mutual, and then we'll send you out an invitation for the next event. So just kind of to remind you of that. The next question, Anthony, we have is, did you have a comment?
No, that's perfect.
Okay.
Go ahead.
The question is, do you limit the maximum issue age of your prospects?
You know, when you get to a certain age, I mean, it can be frustrating through underwriting, but I have, I think my oldest client is, I want to say 75. And I know my mentor, Ray, he's written an 80-year-old. But typically it really doesn't matter, because it's all about, if the older you are, obviously the lower your death benefit's going to be, but your cash flow still runs about the same percentage. That $1 in, 57 cents out runs about the same. Now, obviously, you put $1 in on a 30-year-old, they're going to have a lot more death benefit than $1 in on an 80-year-old. But, you know, the insurability factor comes into play. So if I've got a client that I have a pretty good idea that they're going to go through battle of underwriting, I'll try to get the kids involved. And I like getting the kids involved, because once you get, you know, if you've got an 80-year-old and you've got a 57-year-old son who you bring to the house and you explain this concept, this is what, you know, mom and dad are doing, this is going to benefit you, and they say, well, this is great. So, you know, my dad's going to fund this thing for me, but, well, I'd like to have my own. And I've gotten so many new clients just from bringing the kids in so they can be the insured. And they say, well, can I do this on my kids? Well, absolutely. So you create new clients by doing that.
We had a question here, is kind of tying back to the business question before about the interest being deductible for business expense. I believe you said that was a yes.
It is, yes. You just have to, you know, keep proper records, and that's not it's not an area that I focus on too heavily with the business owners, where they take the loans for the business expenses. You know, a lot of them have that they balk at I think Obama a few years ago implemented that extra tax on the earned interest income, but that still really is irrelevant, because, you know, you pay a tax on an additional tax on that money that otherwise you never would have retained anyway. So, but yes, it is deductible as long as set up properly. You just have to have your tax man, the business owner's tax man, on board, which is another area. We work with a lot of CPAs who gain a new understanding of how this works. And I've never had a CPA come back to me and say, or go back to one of my clients and say, hey, this is a horrible idea. They've all been on board.
Next question, how young of a child does this really work for?
Get them on a newborn.
Yeah.
I mean, the thing about it is, when you do a child, the insurance company is going to say, all right, does mom and dad have coverage? So, and you can't dump, a $20,000 annual premium on a newborn. That's going to buy, several $1 million of death benefit. The insurance company is going to probably look at that and say, yeah, there's, that's too much, according to the human life value. But, I mean, I've got clients who are grandparents and they've got 3 or 4 grandkids, and we'll do, $3,000 or $4,000 on each child, on each grandchild. And so they'll do like a $15,000 annual premium split up, between 4 different grandkids. But I've got policies on all 3 of my kids. My youngest, she was 5 when I took her policy out. I was 35 at the time. I looked at what the efficiency would be when she was 35. If I were to just hand this over to her 30 years down the road, every dollar she put in, it made $4. Think about that. Think about handing your child or your grandchild something at 35 years of age and say, my daughter, her name's Olivia. Olivia, here's a life insurance policy. You have to come up with $5,000 a year. But every time you come up with that $5,000, your cash value will grow by $20,000.
It's powerful.
I'd love to have 10 of those, and that's my goal, is to pass these on to my kids, so that when they are in their 30s and 40s, if they're making $100,000 a year, it's like them making $300,000 a year, just for putting money in their own banking system rather than somebody else's.
I guess kind of an assumption, but the question is basically, I'm guessing that the interest paid by the business is also income to the policy owner.
That is correct. Additional, above and beyond what is the insurance company charges, which would be deductible. So if the insurance company is charging 5%, if they're paying back at 10%. But again, if you look at it as from a volume perspective, and that's an additional 5% that yes, you pay taxes on, but otherwise you would never have. So it's like I'll pay tax on 28 cents of every dollar that otherwise I wouldn't have had the 72 cents to begin with if I never would have done this. If that makes sense.
Yep. Let's see. Next question. Can we do a term rider and convert that as time goes on in place of paid-up additions?
Absolutely. My mentor became uninsurable back in 2002, I want to say. He learned of this concept back in 2000, became uninsurable. Fortunately, he had a substantial term policy that he converted over. And because of that, he does very well. So you bet. And it's a great way. I mean, obviously for insurability purposes. And we've done that too. We've added, because if I talk to a 35-year-old or a 40-year-old who's a family man, and we do this concept, and he puts in $20,000 a year into this, that might only buy him, $600,000-$700,000 of life insurance. Well, that's not enough. If something were to happen to him, he needs additional coverage. So we'll add a term policy on there that is convertible as time goes by. So that way, when he wants to buy his second and third and fourth policy, he doesn't have to go through underwriting.
All right, let's see here. What else we got? Lots of questions. I'm trying to see how this question is laid out here. I apologize for the delay on this one. What companies do we use for whole life products? Well, we use Security Mutual in this case because, and Anthony, you might want to speak to that, why you use that company.
Sure. I mean, they're a mutual company. They have a track record of 124 years in a row of paying a dividend. They're a non-direct recognition company, and their policies are solid. I mean, they run up against the likes of some of the bigger players out there, like New York Life or Guardian, Northwestern Mutual. They so that's kind of my go-to company is Security Mutual. Their underwriting is fantastic. Best underwriters I've ever worked with. They are very understanding about the banking concept. They're very pro banking concept. I've worked with insurance companies in the past who they don't like it. They don't want you doing it because it adds more administrative work for them. But Security Mutual Life is definitely on board, and I know that the IAMS team has a pretty good relationship with them. I work with Sandy Vacanti. I don't know if I'm sure you guys have maybe talked to her, or if you work with her, if you do any life insurance, but she's incredible. I mean, Sandy's kind of like my right arm. I mean, she, through the whole underwriting process and everything, she keeps everything in check and in order. So the IAMS team is just fantastic. Everything I do run through, and any questions and concerns or whatnot, Sandy's on top of everything. So
let's see, another question here. When you pay interest, will that put you to where you will become a MEC without opening another policy?
Right. I addressed that a little earlier. Yeah, possibly. It depends on how much premium or paid-up additions you're funneling through the policy. Because we drop off the PUA, a lot of times you can add that extra interest being charged in as PUA or in as premium, for that matter. It's all about how money moves, but the way we design it, and the measurements that the insurance company has in place, it's actually very hard for anyone to MEC a policy, because there'll be notifications, hey, if you dump this extra money in above and beyond what you can, this is going to MEC. And so there's several different instances on what you do with that extra interest. It might just be take that extra interest and tackle the next debt, or it's just a matter of where it's housed. But no, we will make sure that it's not that your policies will not become modified endowment contracts.
Do policyholders use this for tax-free income? Is the next question from Jerry.
It's got one of the greatest exit strategies I've ever seen. You betcha. I mean, think about it from the perspective of, if you start off like myself, I'm in my 30s. When I, maybe in my 60s, want to start drawing supplemental retirement income off of it, it's based, and I never pay it back, it's based upon my death benefit. And your death benefit may start off with $600,000 at 33 years of age. By the time I'm 60, that $600,000, it's going to be, $2.5 million. So and that's just one policy. So I'll draw off, and that's another thing I'll show you in the next webinar, is how that, I think it'll be the third webinar, exactly how that works compared to another form of retirement savings, implementing the exit strategy. Yeah, I want to pull tax-free income when I retire. I don't want to pay taxes, because who knows what the tax bracket's going to look like 30 years from now. So.
This person is kind of a follow-up to one of the comments made before, but says, you were assuming that the insured is insurable in the future without being rated. What happens then? When do you expect to buy a new policy?
Well, it doesn't necessarily have to be on that person, as long as there's an insurable interest. Like I said, I've got policies on all three of my kids, and I control those policies the same way that I control the policies that's on me. But as long as you're insurable, typically, and every person is unique. I've had people who have bought a second policy within the first year. I've had people who've waited, 3 years, and then they bought their second policy. Everyone has it really depends on how quickly they want to capitalize.
Another question, would you use the money as a payout from their qualified funds and then after taxes, and is there any reason not to?
Well, here's the way I pitch it, and I'm not securities licensed anymore, so I cannot advise anyone to do that. but I have informed my clients who have qualified assets of what other clients have done, and that is put it in this perspective. Let's say you've got a 40-year-old. If he touches his qualified money, obviously, A, he's going to pay taxes, which that's an easy one to get around. Would you rather pay taxes today, or would you rather pay taxes, 20 years from now? I'd rather pay taxes today because I think we're in the lowest tax bracket we're ever going to be in. But then you've got the penalty, and any financial advisor out there would almost tell you, or CPA might tell you, you're nuts at 40 years of age to pull out qualified money because you're going to pay a 10% penalty. Well, let's just say you do a 40-year-old does a $20,000 annual premium. That means they're going to have a $2,000 penalty to 10%. But by taking that $20,000 premium, there's enough cash value in there to buy their car payment. And let's say their car payment was $200 a month. Well, in 1 year's time, that's $2,400. You've just recaptured the $2,000 from the penalty plus an extra $400 that otherwise would have gone to the car payment, or whoever had that debt. So it's all about recapturing money. It's about volume of interest, not about rate of return. It's about how much money are we keeping. So when I explain it to someone like that and say, yeah, you're going to pay $2,000 in taxes because you're not 59 and a half, but by doing this and recapturing your car payment, at the end of the year, you're going to have $2,400 back in your possession that otherwise you would not have had. So when they look at money from that perspective, I'm not opposed to it.
Doris asked an interesting question. Will this cause a money laundering flag?
That's funny. We, one of my agents, we just went and met with some guys with a very unique last name who own a liquor store, and I'll just put it that way. We were joking about that fact that all of a sudden we're going to start getting phone calls from all sorts of certain Italian people, and I can say that because I'm Italian, that want to use our services. Sure. If you run into that problem, that's why we have anti-money laundering, put in place. So that way we're aware of that situation. I've never run into that situation, but if I was gonna launder money, boy, I mean, but obviously there's measurements put in place to prevent that kind of thing. But
Well,
you can see how
Go ahead.
They would think that. No, but you're good.
Well, I was going to say, here's the other thing too. Insurance companies know what's going on here. In fact, they actually create their own marketing pieces for this kind of concept. So sure. It's not anything they're not aware of.
Absolutely, their Security Mutual Life is absolutely on board. Their regional VP, who I've got a relationship with, he's a master at the banking concept and understands it to its fullest. So yeah, they're on board, and they know what's going on.
Okay, I'm sorry. I'm there's some simple one-off questions I'm just kind of addressing that people have. So let's see, what else do we have here? Someone is commenting about the size of Security Mutual, the amount of assets they have. Do you know roughly what they have, Anthony? I guess I don't know off the top of my head.
I don't. I was just up there in June, and I just went over all that. I think I probably got this up at night. I'm not. They're definitely not the largest company, but they've been around, like I said, for 127 years, and they A-rated, and but I don't know those numbers off the top of my head.
Question and comment here. We have a client with huge loans against his policy and a declining basis. NML has indicated he will have taxable income from his dividends when the basis is gone. Can you avoid this?
I'd replace the policy if possible. I'd have to look at it. It just depends if he's in kind of depends on how the policy was originally structured, what those loans look like, based upon his premium. That would be one that whoever wrote that question, I'd love to talk to you offline and get some more details, because we've done that before, where you just replace the policy and you wipe out those loans to avoid future taxation. But it's case by case. It's hard to say without the further details.
Okay, let's see. I had someone who had a good comment here. If I can get to it, lots of questions, and I don't know if we're going to need to answer these offline. Well, this concept, the clients have to qualify for the insurance policy. How difficult? I can answer this one. Is it difficult to qualify for the insurance? It is fully underwritten, and it really depends on the client's health, and that's what we're here for. You can call us and ask us, hey, here's what I have, here's the prospect, here's their health situation, and we can help you with that. So, with whole life, don't we surrender the cash value penalties for the benefit of the client?
Say that again.
Well, it says with whole life, don't we surrender the cash value penalties for the benefit of the client? I don't know.
Surrender the cash value penalties for the benefit of the client.
I'm following that question.
No, I don't. Trying to think what they might be asking. For the benefit of the client, we don't really surrender any cash value, because by surrendering the cash value, you're taking a withdrawal. And you don't really want to take a withdrawal, because by taking a withdrawal, you forfeit, the future dividends on that money. So we want to keep it as a loan. But there's really no penalties. What's in your equity, what's in your cash value, it's 100% equitable, meaning it's 100% liquid, usable, all the control. So that answered that.
This is just a quick thought going back to the one about the being taxable, having the loan. They might consider using the dividends to pay back the loan and then surrender the policy.
It's just like I said, that one, it just depends on where they are. I mean, if they've already pulled, if it's all loans, then they're okay. Mm-hmm. But it's based upon what their premium is. It just really depends how old the policy is, what their cost basis is. There's a lot of factors that would go into play there.
Bill just sent in a comment here real quick on Security Mutual size. As of 2014, they were $31 billion of life insurance in force, $2.67 billion in assets, and $23.5 million in dividend payments. So thank you for that comment. No research needed there.
Perfect.
Let's see. Okay, this is a comment about paid-up additions. Yeah, we can get you more information on that. Let's move on here to another question. This is more of a call me question. So, Cheryl, we can address the issues with Anthony's compensation. I don't know if we really set up any kind of a fee or an arrangement as far as coaching, but you'd have to be contracted and writing the business with us in order to have access to Anthony's coaching, I would say. Okay, we'll address this one offline. Let's see what else I got here, Anthony. I think we're getting it cleaned up here. Yep, it looks like the question box is empty. So, good.
Okay.
All right. Well, Anthony, thank you so much. And we took a lot of time out of your production, because I know, again, you're a very important producer to us and write a lot of premium through this concept. And so certainly appreciate you taking time to do that.
It's my pleasure. I enjoy doing it.
Yeah. And here's what we're going to do next, folks. We will, like I said, we will email you out the contracting. So if you'd like to move forward on this and be on the next webinar, just complete that. And then we will let you know when the next webinar will be scheduled. It'll be by private invitation only. So we would certainly love to see you again on the second of this series of 3. So want to thank you for taking time to join us, and be sure to go out to our website, check out our webinar schedule on the home page. You just click on, go to www.imzinc.com, go down to the bottom of the screen, you'll see webinars, and you can just click on it and you can register for any. And if for some reason or another you cannot attend a webinar but you'd like to know more, at least register, because then what we can do is well, we can email you the recorded version after it's over, and it usually takes about 24 hours before we can have it compiled and then email it out to you. So at least register if you can't make it. Of course, it's always nice to be here on them live so you can ask questions as they come to your mind. So again, thank you all for being here this morning. Anthony, again, thanks for your time. Have yourself a great, have a great weekend. We look forward to talking with you soon.
Thanks, Mark.
You bet. Thank you.